statement of cash flows. The balance sheet and the income statement are prepared using accrual basis of accounting. And we're going to get into that a little bit more during this lesson. So the accrual basis of accounting on the income statement means that we're going to record revenues when we've earned them, regardless of whether we actually receive the cash for that. And we're going to record expenses when they're incurred, when we realize that we have the cost, not necessarily when we actually pay them. We also use the accrual basis of accounting for the balance sheet as well. So we would record, for example, an asset that we purchased even if we haven't actually paid cash for it. So what this statement of cash flows does is helps us to transfer those financial statements, the information from those statements, from accrual basis to a cash basis. So what it shows us is the events that cause cash to change during the period. And we look at cash through the lens of three categories: operating activities, financing activities, and investing activities. So the operating activities are the inflows and outflows. You'll also see that listed as sources of cash and uses of cash. So I'll use that terminology kind of interchangeably. So when I say a source of cash, that means cash came in. And if I say a use of cash, that means I spent cash or an outflow of cash. So these are the inflows and outflows, sources and uses of cash from what we normally do in our day-to-day operations of the business. And we can use two different formats for that. We can use the direct method or the indirect method. The indirect method is the most widely used, and so that's what we're really focused on. So I'm not going to spend much time on the direct method, but the indirect method we'll talk about it a little bit. Again, if you were accounting majors, then I would have you actually prepare a statement of cash flows under both methods, but I think it's going to be okay for you as a finance major if we don't do that. And I think we'll just focus on how to read the statement of cash flows rather than actually preparing it. So operating activities are all the activities that happen under the course of a normal course of business. Financing activities would be the cash inflows and outflows from transactions with creditors and owners. So this is how we're going to finance the business. So if we borrow money, that would go under financing activities. So if we borrow, take out a loan, that would be a financing activity. If we issue stock, that is a financing activity. Investing activities are maybe a little bit different than what you might think that would be. So that is, those are the activities that would involve acquiring and selling long-term assets that we're going to use to generate revenues and other non-operating investment assets. So for example, under investing activities, if we purchase equipment that we're going to use to run the business, so that would be considered an investment into our business. Okay, so we're investing in our business. That's considered an investing activity. So if we purchase equipment, then we're going to assume that we paid cash. So a purchase of equipment would decrease the cash flows under investing activities. If we actually financed the purchase of that, that would increase cash flows under financing activities. So you might have transactions that would affect multiple sections or categories of the statement of cash flows. So again, if we purchase equipment, that would decrease investing activities. So it would decrease cash flows from investing activities. If we finance that with debt, that would increase cash flow from financing activities. And then, to further complicate things, if we, when we make the interest payments, on that loan, that would be considered an operating activity. That would decrease cash flows from operating activities. So interest that we pay on loans is considered an operating activity. And it's an operating activity because the interest is a fee, right? The interest is a cost of financing that particular transaction. And so the fact that we finance that in order to run our business, that's a cost of doing business. So interest is considered a cost of doing business and therefore is an operating activity.